Good day. What was supposed to be a quiet summer has turned out anything but. Usually over the summer months, precious metal prices tend to weaken, with stronger months being typically the end of August through to the whole of September, when everyone is back from holidays. However, over the last 6 weeks, they've been pretty eventful and quite positive for the mining sector. The Amati Strategic Metals Fund is up over 17% over this period, despite the gold and silver prices being relatively flat. The shareholders of this fund will know that we are overweight gold and silver companies at the moment, around about 67% of the fund. The performance over the past few weeks was boosted by our exposure to lithium companies, rare earth companies, and one nickel stock in particular that had a great exploration success, Talon Metals. So let me try and unpack a little of what's going on in the next 5 to 7 minutes. At the beginning of March last year, the gold price was just over $2,000 an ounce. So we've seen a 67% rally in the gold price in just 17 months. Gold equities, if we look at it represented by GDX, the large cap index, and GDXJ, the smaller cap index, have rallied about 93% and 100% respectively, which you can argue is actually quite disappointing given the very strong Q2 financial results that were just reported. Usually the beta to the gold price is around 2 to 3 times. So this is quite disappointing and suggests that there's still a major catch-up rally to come if prices, gold and silver prices, hold these levels. So the reason for the poor performance of the equities is clearly the disbelief in the current level of the gold price, and probably due to the fact that we need an extended period of time before investors start believing, and brokers as well start believing, and start adjusting their forecast even higher. Most brokers, notes that we are receiving in our inbox, are still using a gold price closer to $2,000 to $2,500 an ounce in their financial models to determine what is good value and what is not. That might explain this chart, where we've seen aggressive selling of gold shares into the rally over the past 17 months. In fact, the number of units of GDX is down around 30% since March 2024, and the number of units of GDXJ is down 31% over the same time period. It's quite perplexing for people like me who've been following this market for over 30 years, especially when the most actively managed gold funds are also getting large outflows. All the previous peaks in bull markets for gold and silver have been synonymous with aggressive buying of gold shares and large inflows into the funds. So are we just getting a bit smarter? Is this market simply being ignored for now because the broader markets are also hitting all-time highs? We think it's the latter in this case, and we'll probably need the broader markets to falter or run out of steam before investors turn their sights onto the sector in any kind of in any kind of size. Now, the lithium market has been under enormous pressure over the past 3 years. And this is starting to suddenly come back alive now after the closure of 2 lithium mines in China over the past couple of weeks. One of them is a reasonably large producer. As you can see from the supply and demand table below, thanks to our friends at Canaccord Genuity, the market remains in oversupply in the short term despite the mine closures. However, the quantum is not that large. And if we are underestimating demand, the market could quite quickly go back into deficit. Supply is almost predictable, given that lithium prices today are too low to incentivize new projects being approved. So what we are basically seeing right now is short covering of the heavily shorted lithium stocks. We are currently watching this market very closely to see whether this rally is sustainable or not. A key overriding theme right now in the metals market is the fragility of the global supply chain for key metals and minerals, given the ever-increasing geopolitical tensions between the West and China. Nowhere is the fragility of this global supply chain felt more than in the rare earth metal sector. These are metals used for magnets to power compact, high-torque electric motors that are critical to modern robotics, electric vehicles, wind turbines, drones, and high-tech weaponry. China currently controls 91% of refined rare earth production, creating an acute geopolitical and supply chain risk. Recent export controls by Beijing have already triggered major disruptions across the automotive and robotics industries, highlighting the fragility of this dependency. And we're starting to see a reaction principally by the US. MP Materials, the largest rare earth producer in the West, and the only US company developing a fully integrated mine to magnet supply chain, cemented its status as a cornerstone of America's industrial and national security strategy by striking a deal with the Department of Defense in the US in July. The deal, which was executed under Defense Production Act, guarantees MP a 110 kilogram floor price for its key rare earth products. That was nearly double the market price at the time, and that thereby de-risked production and incentivizes a scale-up of operations. As you can see by the Van Eck Rare Earth Equity ETF, where MP Materials is actually the largest holding, about 12% of the fund, their rare earth strategic metals related equities are at a low point in the cycle right now. We have around 3% of the fund exposed to rare earths at the moment through one stock that has already returned 226% this year, albeit it was off a low base. Our exposure to battery metals is currently around 16%. In general, the whole mining sector seems to be waking up. Rising geopolitical tensions, especially between the US and China, is bringing focus to the supply side risk of metals, and we are regularly seeing comments by the Trump administration about the imposition of tariffs on metals, be it copper, aluminium, 1 kilogram bars from Switzerland, and rare earths. And there's also a realization that AI ambitions require huge metal-intensive data centers to be built and energy generation. Now, generalist investors are becoming interested in the nuclear power generation. And this is all happening with a backdrop of what appears to be a global monetary reset, which is negative for all fiat currencies, especially the US dollar and the euro, but it favors gold and silver prices going forward. One just has to look at the chart of the commodity index versus the S&P 500 over the past 100 years, and you can see these huge cycles. Now, after 10 to 15 years of underperformance, the commodity sector is starting to outperform again. Most funds have very low exposure to commodity-related equities, which we believe bodes well for the sector over the next decade. Around the turning point of the cycle where we think we are right now, it's always going to be very volatile. However, we are starting to see tailwinds building up, just as we've seen in the past few months. I'll end it there with just a short view of what we're seeing in the market right now.